Financial accounting is a vital aspect of business that involves recording, classifying, summarizing, interpreting and analyzing, and number 5 is reporting. Now, what is recording? Recording of any financial information means it should be financial, means it should be some figures, it should be some in monetary terms. So you record that transaction as it happens. The process of capturing of financial transactions as they occur. The process of capturing all financial transactions, all financial means have a monetary value. Whichever have a monetary value, you have to capture that as they occur. Ensuring for every transaction is documented in the accounting system. Ensuring that all the transaction, all the financial transaction is documented in the accounting system. So you have to understand that non-financial transactions are not recorded, it's not a part of financial accounting. So this is very important. What are the non-financial transactions? Like something that customer's loyalty is not a financial transaction. So you don't have to record in financial accounting. It is a part of management accounting. If your customer is not loyal, is not getting loyal, or somehow you are losing customers, is something that is a part of management accounting. But financial accounting just record financial transactions. Now, what is the purpose of financial accounting? The purpose of financial accounting is to maintain a chronological record of every financial activity such as sales, purchases, receipts and payments. Example, recording a purchase of office supplies in the journal. So you have to keep a chronological record. Chronological record means date-wise record. Means today is 5th of April. Tomorrow is 6th of April. Day after tomorrow is 7th of April. So you have to record in sequence. So this is how you have to record in financial accounting. Secondly, classifying. Classifying after transactions are recorded, they are grouped or classified into appropriate categories. Account for better organization and clarity. After transaction are recorded, once the transaction has been recorded, what do? You classify, you group them, you classify them in an appropriate account, like to ensure why. What is the purpose? To ensure the similar types of transactions are grouped together, making it easier to track them. Classifying a recorded transaction. For example, classifying a recorded transaction into office supplies account or accounts receivable account, account payable account. This is how you group. So once you record a transaction, you have to group. Like if I have bought some chairs or some sofa or some lights and these are furniture and fittings. These are items of furniture and fittings. So I will group them in one type of items, that is furniture and fitting. Like for the whole month, for the whole month, I bought on 5th of April I bought chairs. On 6th of April I bought this table. On 7th of April I bought this sofa. And for the whole month, so I bought many things which have the same similarity, that is they are furniture and fixtures. So I will group them in one category, that is furniture and fixtures. One more example is let's suppose I have to pay to A Limited 50,000, B Limited 25,000, C Limited 22,000. These are my creditors. I have to pay them. So I will record in one account, that is accounts payable. No doubt I have to